between lunch and you all. So please bear with us. I promise this is going to be a very interesting session. So thank you. Though we already did cover in a little bit of breadth what we expect oil and gas to look like in the next year. But what we've done is also we've put together a few slides that is going to talk about what we have seen in the past year and what our expectations are for this year based on the research. Before I get into those, I'd like to invite and introduce the three panelists here. Kendra O'Keefe, she is the technical director with SM Energy. We also have with us Francisco Arana, who is the director of Commodities and Business Development with BW Energy. And then we have Carlos Granado, who is the regional director with CMG. So thank you all for being here. So moving on to what we have seen in the past year, we definitely seen the past 2 years where we saw US onshore consolidation took a big uptick. And if you see on the chart on the left, you can see that there has been some correlation with a few years of lag between oil price and also what the M&A activity spending has looked like in the past. So based on what our expectations are for the oil prices, we do see that the activity is going to slow down in the next year. Apart from that, we also see some of the other drivers for the slowdown. One of that is we now see that there's dwindling number of assets that some of these companies could target. We also see that operators are now going to seek mergers among equals rather than acquisitions. And a lot of that is going to be driven by taking advantage of economies of scale and also lower that break-even costs. The other thing that we mentioned is the bleak oil demand and price outlook, which is going to drive some of this slowdown in momentum. However, we do see that lower STC scrutiny and higher capital cost for some of these smaller players will continue to drive whatever slower momentum that we see for M&A in onshore shale. So moving on to the same trend of consolidation, we do see that past few years, onshore shale well productivity had kind of been declining, but we do see that consolidation has been trying to address that, and also it will continue to seek to address the falling well productivity. Although we do see that a lot of low-hanging fruit has been picked. As you can see on the chart here, you see the well count, which is the line, has actually fallen in the past few years. If we look at the trend from 2022 to 2024, we saw that it fell by 7.5%. But then if we look at productivity, it did go up by 4%. So we do see that this trend could keep going on. However, what we have seen so far is, operators have mainly focused on well construction and production operations optimization. However, if we see going on, they'll have to continue to venture beyond the methods that they have adopted and find out new ways that they can cut costs. We also did a very interesting project last year where we tried to understand what does the emission intensity for a lot of these operators look like in the upstream. We did break them down by US majors, whether they were oil-focused, gas-focused, or diversified, as well as looking at outside the US, understanding what the NOC's methane emissions intensities look like based on whether they were oil-focused, gas-focused, or diversified again. We do see that US operators do have a lower methane emission intensity, but if we look at globally, we see that majors have been faring much better and have been setting the benchmark globally. So we do expect that as some of this consolidation happens, some of this methane emission intensity for independents could also come down. Moving on to a little bit, we do expect there will be some sort of a resurgence in offshore oil and gas. If we look, we see that there is going to be some FIDs expected in 2025. A lot of it is going to be driven by deep water, followed by shallow water. And a lot of it is going to come from the Middle East and Africa. as well as some in Asia Pacific. So continuing on the trend of optimization, we see that there has been some optimization and innovation in offshore as well. We see, for instance, Shell has implemented a platform replication strategy where they almost reduced their overall costs by 70%, increasing the IRR from typically about 15% to 25% is what they're expecting out of this platform replication strategy. We are also seeing growing use of automation and AI, as we've seen in the partnership between Equinor and SLB, where they've tried to use AI and to completely drill a well with minimal intervention. If we think of a typical 18,000 feet well, this could save about 2 to 3 days in the region where they experimented, where it was in offshore Brazil, where the typical ROP is 75 foot drilled per an hour. We are also seeing applications like battery storage to replace diesel and gas powered power generation. And we see these kinds of things that are going to not just drive innovation, but cost optimization, as well as lower emission intensity in offshore. Just to begin the panel, I guess my first question would be just to introduce yourselves, the company, and what do you see has been exciting projects that you have worked on in the past year?
I'll go first. I'm Kendra O'Keefe. I help lead our technology strategy at SM Energy. I've been in industry 20 years now. I started on our business side, drilling completions, engineering side of the house, and then moved into the technology space 8 years ago. I think the most exciting thing for us as a company is really stepping out of traditional Permian type of operatorship and trying to explore and exploit Tier 2 assets that are traditionally seen as Tier 2, but we believe with our technical capability are really equal from a market perspective and compete really nicely in our portfolio. So you have to get creative when you're running out of shale out there, and I think it's exciting to see new ideas and new approaches being applied to some overlooked areas in the U.S.
Kendra. Francisco, what do you see lately in offshore and in your business that's exciting?
Sure. Well, good morning, everyone, and pleasure to be with you here today. I work for BW Energy. We're an international operator that is listed in the Oslo Stock Exchange. We operate deep water and shallow water fields in Gabon, in Namibia, and Brazil. I think for us, we're a bit of a startup. We're a company that's in growth mode. Recently, we're a startup. We've had a pretty exciting story. We started as a company, as a special project inside BW Offshore back in 2017 that went and actually acquired interest in a field offshore Gabon, specifically with the purpose of redeploying an FPSO asset. And that launched what is BW Energy today. We achieved first oil in 18 months after redeploying the field and acquiring the license. It started with 10,000 barrels a day, grew that field by adding infrastructure, and now we're sitting at about 50,000 barrels a day of gross operated production across all our assets. So I think what's interesting for us is really how we approach projects, how we approach developments. Companies tend to have a DNA, that informs their strategy. You have some different types of E&P companies. You have your wildcatters that focus on just exploration. You have, operators like Perenco who, focus on mature fields and kind of being a cost leader and extracting every single remaining drop of oil. We focus on developing greenfields, specifically assets that have been stranded, left behind, have proven resources, but no one has figured out how to monetize them. And we go after them by leveraging our infrastructure, history, and legacy. And we redeploy and repurpose infrastructure. So in Gabon, we started off with a redeployed FPSO to unlock that field. We quadrupled production on that field by buying 2 jackup rigs that we converted, one of them which we converted into a mobile offshore production unit, installed that in the field, tied it back to the FPSO. In Brazil, we're working on a development that we're hoping to sanction in the first half of this year. A field that was first discovered in 1980, was well appraised by Chevron and Petrobras, but they weren't unable to commercialize it, and actually ended up being immaterial in their portfolio. When we bring that online through the use of a redeployed FPSO, we'll hope to achieve 50,000 barrels a day, so it'll double our current production today. In Namibia, we have an asset in development, and we pre-invested in a drilling semi-sub that we will repurpose as an offshore gas processing facility if we're able to sanction a development in Namibia. So we're not afraid to pre-invest in infrastructure, and repurposing infrastructure is a key aspect of our strategy.
Thank you, Francisco. Carlos, what about, tell us a little bit about CNG and how you've been helping some of the operators in the past few years.
Sure. Well, my name is Carlos Granado. Thank you very much for the opportunity. I work for Computer Modeling Group, which is a software and consulting global company that provides oil industry clients with the reservoir simulation and surface simulation software. What excited us at this point is that we have grown in the same way that the technology is asking for our needs. For example, we have grown in the sense of the energy transition side of the business. We have implemented technology like artificial intelligence, data analytics, and machine learning in order to help clients to take confident decisions on not only optimizing their assets, but also being able to perform optimizations on the surface, subsurface facility issues, not only for offshore, but also for helping operators in the unconventional side of the business to optimize their paths configurations in order to get the better cost, the lowest cost, and the best profitability out of their investment and resources.
So, Kendra, I have a question for you. We see that there's definitely a lot of uncertainty today in the market in terms of upstream. So, which are the key trends that you see are impacting your operations, and how do you see some of these trends evolve as we move forward?
Yeah, thank you. I think we had a great intro to that. It's a tough time to be in oil and gas this year. One of the things that we will say from our side, from a trend perspective, is the pressure on price. We are not necessarily interested in growing for growth's sake. The capital discipline is extremely important. We need to continue to return value to our shareholders. All of that while continuing to engage an organization coming into the industry who has been kind of anti-industry. So I will say the other piece that is going to be an interesting trend as consolidation happens is that next generation of engineering, that next generation of technical talent to get in the door. Energy is not going away, and being able to continue to recruit in that space continues to be a challenge as we look at the next generation. And then there's also the generation that's going to be leaving us as consolidation happens and retirement happens. So I think there's an interesting trend just on the people side and the capability over there. But growth for growth's sake is not something we anticipate. We really, as an organization, as an industry, need to stay prudent. And I think that we had some really nice examples. You hear on the street drill baby drill, and that's not really what we're going to get out there and go do necessarily. So it's going to be an interesting, I'd say, 18 months as the pressures continue to hit us and technology changes. So we have to be capitalizing on technology where we can to drive the efficiencies, and we're working on that at SM and trying to set ourselves, let's say, differential from our peers. For a small operator of about 700 people, we're trying to lean in as much as we can on the technology front to help really kind of continue to drive that capital efficiency into our program.
Thank you, Kendra. I do have some follow-up questions on that, but we'll come back to them later. So, Francisco, what are the key trends that are driving offshore today? And, what we have seen, and there has been some sentiment change in terms of the favorability of oil and gas today. So have you seen offshore being better, or how do you see offshore trends?
Yeah, I think it's a very interesting question. I mean, especially for a company our size that is looking to grow, and we're looking to grow in order to achieve scale so that we can generate enough free cash flow so we can basically use our own free cash flow to grow inorganically, as opposed to having to raise capital on the markets for the growth. If you look at the slide that you shared with developments that are going to be sanctioned potentially this year, I mean, these are all massive developments, multi-billion dollar. I think I was reading the other day that Exxon's latest development in Guyana is $10 billion development. That's kind of where we've seen the industry lately, these massive developments, and the pace has been fairly slow. And Gato de Mato was on that slide. That thing has come close to sanction a couple times and keeps getting recycled, which is not uncommon in these larger companies. I think the trend that we're going to start seeing offshore is hopefully we're going to have a lot more companies of our size going after smaller projects that aren't as exciting to the super majors or the larger ones, but there's a lot of oil that's still ready to be developed. You've got operators that, you have super majors that are trimming their portfolios and divesting non-core assets that'll provide opportunities for smaller companies like us to step in and assume either an operator's role or a non-op position. I think we're starting to see hopefully some positive signals that momentum is going to be with these smaller operators. We'll be able to raise capital hopefully a little bit more easily than what we've been able to historically.
Thank you. Carlos, we know that CMG is one of the key tools that some of these oil sands or conventional, unconventional, heavy oil players use. So how do you see the trends with some of those customers, and how do you see the market for them going forward?
Yeah, well, it's obviously been a couple of tough years for the oil sand operators, especially with the pressure of having less impact in the footprint of the CO2. And we know this type of production, especially for oil sands, is really carbon expensive. Not only because of the need of producing steam in order to make this oil movable, but also because of the amount of processes you need to account, and even the drilling in order to complete them, to produce these wells. However, the companies has been moving forward the path of having a greener portfolios. We have seen initiatives in Canada like COSIA, which is Canadian Oil Sand Innovation, which consists in a group of companies and operators that produce from thermal, that they have get together in order to find options to capture and transport the CO2 becoming from their operations and injected somewhere in Canada, even using 100 kilometers of pipes in order to collect this, so other operators can also get plugged into it and dispose their CO2, so they kind of come to a more greener way of producing their sands. They are investing a lot of efforts in order to generate solvent-based enhanced oil recovery processes in order to reduce the consumption of water. They have come with technologies that include perhaps water closed loop, where they reuse the water that they inject in order to use less water into the clean water, and that would also, of course, reduce the impact on the environmental and the cost of the projects as well. So it's been a couple of it's been tougher for the heavy oil and oil sands operator, but they are, moving themselves toward a more greener path. And oil sands are going to be an important source of energy for the coming years and for the coming decades. Well, perhaps they will need to invest in projects that grant that they are going to be coping with the not only the sustainability, but also the needs from governments, from regulators, and also for society in order to have a cleaner operation. So.
Thank you, Carlos. So, obviously sustainability has some cost associated with that. That brings to the discussion on cost and economics. So, Kendra, for you, is how do you see or how are you optimizing cost and upstream? I know you mentioned diversifying asset base. So how has that, how do you see that experience comparing, say, the Midland bases to the latest, the one that you acquired in Uinta Basin? So how do you see some of these cost and economics change as you consolidate?
Yeah, thanks. So SM's been really focusing on ESG and our sustainability, not only because it's the right thing to do, but it's been probably one of our top focuses over the past 5 years, and we've driven down our flare rates, our emissions pretty significantly, really through data and analytics, through being able to see visibility to it. It's a trade-off. Every time you make a decision, we're looking at kind of the return on what that trade-off is and the cost of it. It doesn't pay out for itself, quite frankly, but it is actually, the longer we've got some time behind us, we are actually getting a little bit closer on the economics for that. But as we look at our Utah assets, new for us, and it was a smaller operator, and we will focus on the ESG and really optimizing in that space. There's a really large opportunity for us to be able to mitigate some of our flaring. Some of the things that we've taken from our Permian Basin, we will be applying those in our Utah assets. And quite frankly, the Rockies has a long history of recycling water and really some different approaches that we haven't necessarily had to take advantage of in South Texas or West Texas. And so we'll take kind of the best from both and continue to focus on ESG, regardless of whether it's kind of government mandated or externally focused on. It really is just good stewardship and the right way to operate.
Thank you, Kendra. So, Francisco, I know you mentioned that there's definitely going to be some growth component for smaller operators in offshore. And you also mentioned that you maybe find it easier to, say, get more capital. So how do you see, what are the different ways or where do you see the innovation when it comes to, say, capturing more capital for some of these offshore projects, regardless of where the cycle is?
Yeah, I think to answer that question, I got to take a step back and talk a little bit about the impact of ESG on us. I would fully agree that we want to be prudent, responsible operators and good stewards of the environment. And I would also agree that we want to maintain our social license to produce fossil fuels as long as possible. But I would argue that what that social license looks like is probably different depending upon where you're operating. We're operating in countries like Gabon and Namibia, where monetization of their natural resources is their only or main source of revenue. And on top of that, they are starved for primary sources of power. And so when they look to us, they ask us, are you doing everything in your, that you can to produce the barrels that are, stored and stuck underground? They want more production, not less. And unfortunately, in some of these regions that we're operating in, there isn't really infrastructure to capture emissions and avoid flaring. Associated gas comes up with production, and the options are either to flare it, or if you don't consume it for power, you have to flare it, or you'd have to drill injection wells to basically store the gas underground, which may not be economically viable and may imperil the economics of the project for moving forward. And as we're struggling with this, we've seen ESG influence on capital sources, and it's been a struggle for us to find the capital to develop and move these projects forwards. If you look at both sides of the capital stack, on the equity side, we see that companies, their primary business is fossil fuels, and their market cap is undervalued versus other companies. On the debt side, we've seen lenders disappear. It used to be that if you wanted to fund a development, you could do reserve-based lending, and there would be tons of European banks that would be ready there to lend their capital to the projects. And what happened is, we did an RBL for Gabon 3 years ago, and it was probably the last transaction that a couple of those European banks did, and today they've all exited. So innovation for us to move these projects ahead has been, how do we find capital when the market and the lenders evaporate? And that's meant, finding new sources of capital. So, we've gone and explored lenders we historically haven't looked at before. There's a lot of lenders that are interested in providing capital in the UAE, but they don't understand the E&P business as well as the European banks historically did. We see trader offtake financing becoming a much more prominent source of capital, but you got to be very careful because traders tend to be sharks, and they'll take every dollar that they can, and if you don't understand that part of the business very well, the lending becomes very expensive. And finally, we've actually started looking at infrastructure to kind of raise capital. So working with banks to basically sell and lease back our infrastructure as a way to raise additional sources of capital. So that's kind of the innovation on the financing side that we've been trying to do.
So I have a follow-up question on that. So you mentioned the infrastructure lease-based model. Would that infrastructure still be oil and gas related infrastructure, right?
Yeah, so it would be the infrastructure that we would utilize on the field. So on the jackup that we converted in Gabon, we worked with a financial counterparty. We sold the Mopu once converted. It's production. It's sitting in Gabon operating. We sold it to them. They own it, and we lease it back from them. And it's a finance lease. So at the end of the day, we'll end up owning it again at the end of the term. But it's a way to raise capital. We're exploring doing the same with FPSO for Brazil, and it's. So banks are basically looking at the infrastructure as a security for their financing rather than the reserves themselves.
And then, so would those be the same banks, or would these be different?
These are different banks, completely different banks.
Thank you. So, coming to ESG topic, Carlos, are your say customers asking for some specific needs, or are there some specific tools that you've been asked to create to help your clients achieve their goals in terms of sustainability, or is it something that you offer and then they use more of, or how does that work for you?
Yeah, we offer a variety of technologies in order to help our clients to cope with their ESG requirements. Basically, in the last years, CMG itself have turned themselves a very important part of their development towards the implementation and the understanding on all the phenomena related to CCS. Some of our clients, mainly the oil and gas clients, are very concerned about these initiatives, and they are really into the sponsor on the implementation of these type of projects in order to reduce their impact to the environment. CCS might sound like a simple process, but at the end it has a lot of uncertainties related to it. And in order to safely storage these amounts of CO2 either in saline aquifers or depleted reservoirs, we need to clarify and to reduce the uncertainties, not only related to the storage capability but the type of phenomena that are going to trap the CO2, how the CO2 is going to be storage, is it going to be in solid, is it going to be in solubility, is it going to be free phase gas flowing inside that porous media. That would have an impact because you need to account for the cap rock integrity, the integrity of the wells that exist on those particular assets, if this is a case of depleted reservoirs. What is the impact of the changes of phases on the CO2? CO2 is a really complex gas that behaves in a particular way, so you might expect to have some freezing effects in the wellbores that might damage the integrity of the well, damage the formations. So as you see, there are plenty of issues, either fault reactivations. When you're injecting a large amount of CO2 into a formation, you need to account for those faults that are into the formation, because the CO2 might leak through them, and we don't want to just solve a problem today to have another problem in a couple of years. So all these issues help. We actually help our clients, our customers, to cope with this type of project, to understand the phenomena. We train them, we guide them through the process, because now they are oil industry, but they need to become, their expertise need to increase toward that other area that they are not necessarily involved. So one of our strengths is to help the clients toward that side. On the other hand, we help the clients with our analysis, with our technology, in order to optimize their projects, to reduce costs, to perhaps have a less number. For example, 10 years ago, the way the unconventional assets were developed are really different to what they are developed right now. Implementation of new technologies, horizontal wells, the type of fractures we are implementing these days, the path type of development that we are doing right now. Granted, we have a less impact on the environment because of the locations that we use now. We reduce costs because of the transport and drilling, and also this technology. Well, you need to optimize the way those wells are drilled, the spacing of them, which is the optimum fracture density, which is the optimum half length of the fractures. That's on the unconventional side. in the offshore side of the business, we have become really active in developing the IPSM technology, which allows our clients to not only know what happened in the reservoir, but also what happened in the surface. And we use our technology of artificial intelligence and machine learning in order not only to optimize the reservoir side of the business itself, but optimize both sides together, surface and subsurface. So the decisions that we can offer the clients is a kind of automatic optimization of their fields that have proven to have cases by doing these twin digitals of incrementing the production in 15% by just running some mathematical models. So that saves a lot. That gives the clients a lot of support towards the implementation of safe technologies and to reduce costs and have a less environmental impact.
Thank you, Carlos. So, Kendra, I know we did touch upon ESG and how we have to continue to be prudent in terms of our expectations from production. But a trend that we are also seeing that operators are committing to cut methane emissions and flaring to stricter points today. So how do you see that faring across the assets and in the upstream in general? How do you see how much have we come in terms of what we have committed to in cutting methane emissions?
Yeah, thanks. I think it depends a little bit operator to operator, and different people are optimizing for different things. Are we perfect at a zero flaring down in the Permian? No, you can fly in at night and see that we're still doing that. But certainly we're making progress, and we're committed to continuing to make progress down there. I think Francisco was spot on. Your license to operate looks different in different places. Our headquarters are Denver, Colorado. We absolutely have a different conversation with people in the local areas versus what you might have with folks in Texas versus what's going on in the Rockies and Utah. I think there's a certain amount of I wouldn't say zero tolerance, because you have to be able to manage upsets and what's going on in your field. You have to have the ability to be safe, and flaring really provides safety at given times depending on what's going on in your field operations. But it's a lens that we try and continue to prioritize as we are looking at field development, and we make choices on any given day about what's going on operationally and try and prioritize if we have to shut in to mitigate flaring, and there are times we'll do that. So I think we've come a long way. I think there's still opportunity as we move forward, and it really is driven by, I think, the environment that you're in, and that's not, regardless of who's in office, I don't think we're going backwards as to kind of the levels that we'd like to continue to see progress on flaring, and just in general kind of good stewardship as we're looking at field operations out there.
So Kendra, on paper we do sometimes make this case that when you capture all that gas back and you don't flare it, there could be some cost associated, not just for capturing, but then you can also make some of that money back when you are able to sell it. So is that a big impact, or is that not? How has your experience been?
Yeah, we're actually working on a model for that right now, just to try and quantify the full kind of cost of ESG and what the payout looks like. And it's an on-paper exercise. It is not enough to say that it's an economic thing. You can't go out there and say we're driving higher returns because we're not flaring X amount of gas out in our Permian asset. It still is it's a sunk cost. It's the price of doing business. It's moderately offset by the fact that you're capturing gas and you're able to sell it. But it's certainly not a driver, and it's not something we can say right now, for us anyway, is an economic endeavor, but it goes to that bigger kind of right to operate as an operator out in that basin.
Thank you. That's helpful. So, Francisco, how do you think some of your assets could say improve on plain economics basis? What are the ways that you could improve there in terms of innovation?
Yeah, I mean, I think we look at cost competitiveness on two sides, CapEx and OpEx. The biggest expenditure of capital comes at, when you're developing the project at the front end. And the way that we try to reduce our CapEx is to phase our projects. We see that historically a lot of the bigger, especially the super majors, they kind of get stuck on what we call the development hamster wheel, where they find some oil and think there's a whole bunch of oil there, and they come up with a concept, and they come up with an estimate and development plan, and they realize that the economics are pretty tight, so actually let's see if we can prove up that there's some more oil. And they do a bunch more drilling, which obviously is more investment, and then they sometimes find more oil, or actually find that it's less oil than what they originally anticipated. So they start in this iteration, and a lot of these projects take forever to develop. If you look at the Maromba project that we have in Brazil, we bought that from Petrobras and Chevron. It has 9 penetrations across the field, and I think it was first discovered in 1980, and it hasn't been monetized to this day. So our approach is to kind of get off that development hamster wheel and really phase our developments to where we're minimizing the size of that first phase. We want to minimize the level of investment. We're going to target the lowest amount of reserves that we need to make this thing economic, and just make sure that we achieve first oil, start producing, and then once we've actually started production, then look at how we optimize and how we grow and how we go after upsides. The Maromba project, which again we hope to sanction later this year, we're going to do that on the basis of 100 million barrels recoverable as the first phase. But there's actually a lot of upside, and there's a carbonate play that you can go after that could potentially hold 1 billion barrels. But you won't know that until you get there and drill some pretty expensive wells. We're not going to drill those wells and take the risk that there's nothing there, when we know that there's 100 million barrels sitting there that we can produce. So I think phasing projects and trying to minimize and getting to first oil is the way that we try to be cost competitive on the CapEx side. On the OpEx side, I mean, we have the same struggles that every operator does, and we're subject to the same types of cost escalation that we're seeing across the industry. I think where we also struggle as well is, while we're trying to implement technology and become leaner and more efficient, sometimes becoming leaner is not in the best interests of the local governments. They want you to run your operations with less expats and more locals. And when you tell them that you're actually going to trim the size of the operations team, they're not too excited about that. So I think that's one of the struggles that we have on OpEx. Yeah.
So, Carlos, my question for you would be, how do you help some of these legacy oil and gas customers achieve their ESG goals? I know you mentioned CCS, but what about the companies that are not into CCS and just oil and gas production?
How do we help them to
achieve their sustainability or ESG goals?
Well, we are a strong believer on the uncertainty assessment in order to account for the uncertainties that might arise on the operational side of the business. We use a lot of our technology in order to keep improving or optimizing the way our clients operate their fields. or they intend to include further developments. We go hand to hand to the technologies in the sense that, for example, for unconventional operators, they're keeping trying to optimize the way they frac their wells, the technologies that they use to fracture wells. So in that sense, we have been developing tools in order to be able to represent the geomechanical part of the business and to incorporate it to reservoir simulation models in order to grant that the decisions that are being taken goes along with what is the best for their economics. Okay, that is in the sense of the unconventional. For the offshore side of the business, we have gone ourselves into a deep development on surface facility models, numerical models that allows the clients to work with IPSM and with optimization tools in order to perhaps develop some kind of digital twins that allows them to do what if sensitivities or optimization without going that into the field. Then with this optimization, it will ease them to take decisions towards what is the best for the reducing of the cost and the increment of their profitability. So that's the way we actually work with clients. Of course, all on the hands of also offering new solutions in order to offer new technologies in order to guide them toward what is new from the searching space into the feasibility of application inside their own assets.
That's helpful. So I could keep going on, but just to respect the audience, I'll open the floor up for the audience if they have any questions for the panelists.
Thank you. My question is for Kendra. And Kendra, I'm wondering if SM has any assets in the Delaware portion of the Permian Basin, and if so, what we're seeing is a lot more H2S gas and CO2 mixed in with the methane that's needing to be captured, and that's requiring some different types of technology, especially on VRUs. And just wondering if y'all are seeing that and any thoughts you may have there.
Appreciate the question. We actually don't have anything in the Delaware. We're all Midland Basin. I've seen some of that with some other operators and some of the challenges out there. We're not seeing that on our side at this point. So unfortunately, I don't have anything super enlightening to comment on that one. But I guess just as an anecdote, I would say I think innovation comes out of challenges like that, and we'll continue to see new technologies being applied, as people aren't just going to leave that behind. They're not going to stop developing. They paid a lot for that acreage over in the Delaware, and so I would anticipate we'll continue to see the technologies emerge over there that will help mitigate risks in that space.
Angela.
I've been hearing news around produced water concerns and that may be beginning to impact economics. Is that something that you're looking at, or if you're seeing any concerns in that space?
I can comment, and then anybody else. So certainly produced water is one of the things that, it is part of the package. We have a combination of recycle, and so we have recycle goals that we like to try and hit, so we can take produced water and use it for frac. We have injection wells that help us mitigate kind of trucking all over the basin. So our preferred is a bit of water treatment, local disposal. It's a combination. A little bit more challenging in the Rockies. We don't have the infrastructure built out there in our new Utah asset, but certainly they have a high recycle ratio over there. I think we're at like 80-something% recycle ratio. So creative kind of ways to try and deal with that.
Yeah, my question is about exploration. We've talked about mature assets and things like that. Without exploration, we have no future I'm an upstream hand, and that's important. What do you see the trends for exploration, both inside the U.S. and outside the U.S.? I'm talking about rank exploration stuff that really develops new basins. I mean, we have Guyana, which was great success a few years ago. Are there new things on the horizon? Are we going to see new wells being drilled overseas, especially for new basins?
You want to tackle the domestic?
I can do that. So on the U.S., we're one of the probably rare operators that has maintained a small exploration group all the way through from pre-COVID days. We didn't cut our exploration program. We don't talk publicly about that program. You have to drill a lot of wells to hit that, but we continue to. I'm excited on the exploration side. Adding innovation and kind of the machine learning, the AI capabilities, the ability to go find old data and use it in new ways. I think we'll see exploration continue to happen in the U.S. There's only so much shale out there, and so certainly SM believes in exploration. We continue to focus on that as part of our portfolio. We're looking at unique things. They don't always pan out, but I think the exploration piece is certainly something we'll continue to see probably over the next 5 years, especially with the consolidation. There'll be probably more capital being added to exploration departments. I'm hopeful. I'm not the explorationist, but I certainly partner with our exploration team and the stuff that they're doing from a technology perspective and the creative mindset they are trying to tackle problems with. I think we've got a really unique opportunity where technology, historic data, and good scientists are going to be able to find new innovative things.
Internationally, thank you for the question, because I think it's one of the things that makes me really excited about the prospects for the offshore industry. You're going to get the perspective of a small company who really can't afford to spend. Well, we're going to drill what is a quasi-exploration well. We qualify it as an appraisal well in Namibia, which is obviously a very hot spot right now for offshore exploration. And it's probably going to spud in third quarter. It's a very expensive well, and for a company that has a market cap of probably $750 million, it's a substantial portion of our market cap. So you'll get the perspective from a small company that we are. But I look at exploration from a business development perspective as kind of the engine, as you said, that drives all the activity. It really is a starting point. And what you've seen probably the last couple years is there's been a lot of focus on what they call, ILX exploration, infrastructure-led. It's, buzzword. It meant that, they're only going to target exploration for prospects that are within tieback to existing infrastructure. The main reason was because it was cheaper to tie them back, and because you really turn them on, go from discovery to production very quickly. Everyone was worried about when is oil going, the demand, when is peak demand coming? We want to produce these barrels as quickly as possible. So that's really where the focus was. What you've seen, I think, over the last probably 5 years, especially given the success that Exxon has had in Guyana, is now you're seeing some wildcatting going on offshore. Namibia, of course, has become, again, a hotspot for that. All the super majors are there, except for, I think, BP. They're, Chevron, who I don't think has done, a ton of crazy exploration lately, has acquired some interest offshore Namibia, so they're getting excited about doing some exploration. You've got Exxon doing some exploration in the Mediterranean. I think they've found like a massive gas discovery. So I think wildcatting and rank exploration is sexy again. I think you'll start seeing a bit more activity in new areas. They say that Uruguay, a lot of companies have had their eyes offshore Uruguay as a kind of analog to Namibia. So people are going to start getting interested there. And what this does is really kind of start the market of opportunities, right? Because you'll have a super major who goes out and does a couple of exploration wells, and maybe they're successful and they start doing a bit more. And then at some point they start trimming their portfolio like Exxon has done in Guyana and said, okay, here's the area that we want to focus on. And what you see in Guyana is anything that Exxon has retained, they've been wildly successful with all of their exploration. And all the acreage that they've kind of given back, the other companies have come in, what I call the secondary market, secondary opportunities for explorationists. They haven't been as successful as Exxon, but I'm confident they'll find something there. And what you do is, you start finding these portfolio, you start understanding a region better, and all these opportunities end up falling out at some point from the super majors. They become immaterial or just not as interesting as some of the newer areas they're looking at, and other companies step in and try to do something with that, whether it's do some additional exploration or companies like us and say, wow, you found 100 million barrels. I know that's tiny for you and that's tiny for that kind of area, but we can make that work. And we'll step in and then try to develop it. So exploration is really important for the generation of kind of secondary opportunities, and I'm quite excited to see that exploration is really taking up.
Thank you, Kendra. Thank you, Francisco. Do we have any more questions?
Hi guys, thank you for this insightful panel. My question goes to Francisco. You mentioning that BW Energy does repurposing of infrastructure. I would guess this is a really high upfront capex. So my question would be, how do you manage that with sustainable long-term business growth?
So the question is about the level of capex for redeployment?
Yes.
I mean, I think from our perspective, we see that a repurposed infrastructure. There's already been a substantial amount of capex already invested in that thing. New build construction for floating infrastructure is really expensive. So if you can grab something that's existing and find something that's a good fit, it's easier said than done, but it is possible to find something that's a good fit. You have to minimize the amount of modifications and life extension that you have to do to the existing infrastructure. Yes, you definitely have to sink some investment, but the business case is it should be less investment than what a new build will cost. There are some trade-offs, of course, because when you have repurposed infrastructure, you'll probably have more ongoing maintenance than if you buy something that's shiny and brand new and put it out and it's ready to be out there for 30, 40 years. But we're trying to make projects that are tight economically work by reducing upfront investment.
Thank you. So we are almost at time. Thank you so much, the panelists, Kendra, Francisco, Carlos, for being on the panel and agreeing to speak. And I'm sure you'll be around, so we'll have more questions. We'll reach out to you.
Thank you.
Thank you. Thank you, everyone.